Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve continues its holding pattern as we hit March 2026, and the banking sector is showing clear divergence that traders need to watch. Today, we're breaking down what the current rate environment means for your portfolio positioning across financials, fixed income, and rate-sensitive assets. According to JP Morgan's analysis following the January 2026 Federal Open Market Committee meeting, the Fed left rates unchanged to start the year. This follows a pause pattern that's creating distinct winners and losers in the banking space. The key question now is a cut coming, and how should traders position ahead of the next move? Let's start with where we stand right now. The Federal Reserve maintains its target range in a holding pattern, with Chair Powell and the FOMC emphasizing their data-dependent approach. According to Trading Economics, the current federal funds rate reflects the Fed's cautious stance amid complex inflation and employment dynamics. Every inflation print, every jobs report, every GDP revision is moving probabilities for the next policy shift. What matters for traders today, it is how this translates into sector rotation and asset class positioning. The banking sector is not moving as a monolith. We're seeing a clear split between regional banks and large financial institutions, and understanding this divergence is critical. Regional banks are showing heightened sensitivity to interest rate policy changes. These institutions have more concentrated exposure to net interest margin compression. When the yield curve flattens or inverts, their core business model takes a hit. They borrow short and lend long, so the spread between short-term funding costs and long-term loan yields determines profitability. Right now, yield curve dynamics are keeping pressure on regional bank margins. Contrast that with large financial institutions. The major money center banks have diversified revenue streams that insulate them from pure interest rate sensitivity. Investment banking fees, asset management, trading operations, wealth management, these lines of business buffer them against rate environment volatility. While regional banks swing with every Fed signal, large banks maintain more measured performance. According to State Street's market outlook for 2026, market signals and shifts this year revolve around sector rotation patterns tied to monetary policy expectations. Capital is moving between rate-sensitive and rate-insensitive sectors as traders reposition for various Fed scenarios. The yield curve remains the critical indicator here. The relationship between short-term and long-term Treasury yields tells you everything about market expectations for future rate policy. When traders anticipate cuts, long-term yields often decline relative to short-term rates, steepening the curve. That's positive for banking sector net interest margins. When cut expectations fade, the curve can flatten or invert, squeezing bank profitability. According to Charles Schwab's 2026 Fixed Income Outlook, Treasury bonds and broader fixed income markets are navigating this uncertainty with positioning across the curve. Traders are watching duration exposure carefully. If cuts materialize, longer duration bonds win. If the Fed holds longer than expected, shorter duration positioning protects capital. Goldman Sachs published their outlook for Fed rate cuts in 2026, highlighting the data-dependent framework that makes probability assessments fluid. Inflation metrics remain the primary focus. Core personal consumption expenditures, the Fed's preferred inflation gauge, continues driving policy discussions. Employment data adds another layer. The Fed has a dual mandate: maximum employment and price stability. Any significant softening in labor markets increases cut probabilities. Any reacceleration in inflation keeps rates higher for longer. Nuveen's FOMC meeting commentary following the January 2026 decision emphasized that the Fed is in no rush to cut. The central bank wants confirmation that inflation is durably moving toward the 2% target before easing policy. This cautious stance keeps markets in a holding pattern, with volatility spiking around each data release. Now let's talk about how this plays across asset classes beyond equities. Fixed income markets are pricing in multiple scenarios. Treasury traders are positioning for different Fed paths, creating opportunities in various parts of the curve. According to BlackRock's iShares Fed Outlook for 2026, Rate forecasts and fixed income strategies hinge on inflation, trajectory, and growth dynamics. If inflation cooperates and growth slows moderately, cuts become more likely in the second half of 2026. If inflation proves sticky or growth remains resilient, the Fed stays on hold. The crypto markets are also reacting to Fed policy signals. According to FEMEX analysis of the FOMC March 2026 rate decision impact on crypto, digital assets show sensitivity to monetary policy changes. When rate cut expectations rise, risk assets, including Bitcoin and Ethereum, tend to rally as liquidity expectations improve. When the Fed signals a more hawkish stance, crypto faces pressure alongside other risk assets. West Africa Trade Hub's Guide to FOMC, Meaning in Crypto for 2026, explains that Bitcoin and Fed rate decisions have developed a correlated relationship. Lower rates reduce the opportunity cost of holding non-yielding assets like Bitcoin. Higher rates make yield-bearing assets like Treasury bills more attractive relative to crypto. This dynamic creates tradable opportunities around Fed meetings and major economic data releases. For traders positioning in the banking sector specifically, the ICBA published Fed Policy Outlook for 2026 focusing on FOMC changes and rate implications for community and regional banks. The analysis highlights that smaller institutions face greater challenges in a prolonged, higher rate environment, especially if the yield curve remains unfavorable. So what does this mean for portfolio positioning right now? First, recognize the divergence within financials. Large cap banks with diversified revenue streams offer more stability. Regional banks offer higher beta to rate policy shifts, creating both risk and opportunity depending on your Fed view. If you believe cuts are coming in the next 6 months, regional banks could outperform. If you think the Fed stays on hold through 2026, large cap banks with diverse businesses offer better risk-adjusted returns. Second, fixed income positioning matters. Duration exposure should match your rate outlook. If you expect cuts, extending duration captures capital appreciation as yields fall. If you expect the Fed to hold or even hike if inflation reaccelerates, shorter duration protects against price declines. Third, watch the yield curve as your primary indicator. A steepening curve signals improving conditions for bank net interest margins and typically positive for financial sector performance. A flattening or inverted curve warns of compression and potential economic slowdown concerns. Fourth, crypto traders should monitor Fed meeting dates and major economic releases. Volatility around these events creates short-term trading opportunities. The longer-term crypto trend will correlate with overall liquidity conditions and risk appetite, both heavily influenced by monetary policy. The data-dependent framework means every release matters. Consumer Price Index, Producer Price Index, non-farm payrolls, jobless claims, GDP revisions, all of these data points shift probabilities for the next Fed move. JP Morgan's global research on the Fed's next move emphasizes that no single data point determines policy, but the cumulative weight of evidence drives FOMC decisions. Current market positioning shows traders hedging for multiple scenarios. Options markets reflect elevated uncertainty premiums around Fed meeting dates. Credit spreads remain relatively tight, suggesting confidence in economic resilience despite rate policy uncertainty. Equity sector rotation favors quality and diversified revenue streams over pure rate-sensitive plays. The takeaway for active traders: stay nimble. The Fed's data-dependent approach creates a fluid probability landscape. Position sizing and risk management become critical when policy direction remains uncertain. Use sector divergence within financials to express nuanced views on rate policy timing and magnitude. Monitor yield curve movements for early signals of changing expectations, and recognize that cross-asset correlations between equities, bonds, and crypto around Fed policy create opportunities for those who understand the transmission mechanisms. The banking sector rotation we're seeing in March 2026 reflects this uncertainty. Capital is flowing toward institutions with operational flexibility and diverse revenue streams, while remaining cautious on pure rate-sensitive plays. This rotation will continue until the Fed's path becomes clearer, either through explicit forward guidance or through accumulating economic data that narrows the probability range. For portfolio construction, Balance your exposure. Don't concentrate entirely in rate-sensitive sectors when policy direction remains uncertain. Use fixed income to hedge equity risk and manage overall portfolio duration. Consider how different Fed scenarios impact each of your positions and stress test your portfolio against multiple outcomes. The March 2026 environment demands active management and tactical positioning. Buy and hold strategies face challenges when the policy landscape can shift dramatically with each data release. Traders who stay informed, monitor indicators closely, and position flexibly will navigate this environment most successfully. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.